Hey, Scott.
Welcome back. Talked to a lot of people lately, some of the biggest investors in the world, about opportunities in credit, fixed income, and I want you to listen to what they told us over the past week or so, and we can react on the other side. Listen.
The 10-year Treasury is overvalued by about 200 basis points in yield. In other words, it could fall a couple of percent in yield if there's a recession next year, which is kind of what the model seems to be predicting. So that's a pretty interesting way of maybe making some money, but it allows you also, by owning those securities, it allows you to buy this bombed out credit market.
Lately, I've been buying some of these treasuries, and sort of amazing what you get paid for it, right? So you get, we got over, or, you know, you put it in certain areas, we got 5%, so we have that.
We especially increased our exposure to high yield and to longer dated credit. Investment grade securities. We continue to be overweight credit. We continue, we're going to hold our existing positions.
All right. So the implication is that you've had an almost unprecedented opportunity in fixed income because of what the Fed is doing. You agree? Does it still exist?
Absolutely. We still have, right now we have some of the best values we've seen in fixed income going back to the global financial crisis. IG corporates, yielding 6%, leverage finance yielding anywhere from 7 to 10%. Emerging markets, high yield emerging markets, 13.5%. And can't forget munis, Scott. IG munis, taxable equivalent yields in the mid sixes, and then we have a high yield yielding over 10%.
It's funny, you say munis. Let's just focus on that area just for a moment, because it's one of the things I asked Jeffrey Gundlach about when we were last together. Yes, there was a great opportunity. Not so sure it still exists. That's what he thought. Maybe it's a little rich now. What do you think?
Well, munis, the high yield muni space was off as much as 17%. Now we're off about 13. IG was off about 13. Now we're off probably 9. I still think there's value there. Underlying fundamentals of the muni market have actually improved. Tax collection revenue is up. Your house, you're going to get a reevaluation sticker, so they're going to even have more funds coming in. $540 billion of stimulus. If you look at the unfunded pension liability states, Connecticut, New York, New Jersey, Illinois, California, they haven't been in better shape in quite some time. Very seasonal market. I would tell you that if you're going to play munis, probably the next 3 months is a good time to play them.
Okay.
Not a better entrance.
Okay. There's considerable turmoil, I think is fair to say, and maybe it's an understatement in the mortgage market. You like various parts of credit within the mortgage space.
Yeah.
How does that all factor in?
Yeah, I mean, the mortgage market's definitely suffered. We've had a backup in rates. We've had an extension duration, but we've been very, very high quality in mortgages. We're buying non-agencies, which have outperformed the agency market. Right now, you're getting, durations probably 4 to 5 years, but you're getting yields of about 7% for AA assets. So I think it's a good hold in the portfolio. And eventually they'll catch up to the rest of the market.
But how do you factor in what a Bullard, for example, says today? You must be gaming out what the Fed's going to do to see if these investments are still going to be good and where the various entry points may exist or where the door may shut. Yeah. So how do you think about that?
Yeah, I think he's definitely an outlier. Maybe you have to go through an oil shock that we saw in 73 or 79 to get to his terminal rate of 7%. I mean, there's other variables out there. Energy is actually down today. The two prints we had, CPI and PPI, are not a trend. They're data points. So the Fed wants to remain hawkish. They're going to continue to raise rates. They're tightening financial conditions. Maybe this latest move was a little bit of a head fake like we saw back in June in the credit market, Scott. So we're up in quality, whether it's high yield, whether it's investment grade, we're in triple Bs, whether it's bank loans, we've gone up in the capital stack. A lot of people said they were going to do that. Now we've been doing it. Re-underwrote credits, looked at the impact on a slowing economy. How does inflation impact the companies? And we did that a year ago.
Okay. Got in early, ahead of the crowd, as you've been known to do. It's good to talk to you. We're up against it today with time and breaking news and earnings, et cetera, but it's good to see you.
Thank you very much.
All right. That's David Albrycht.